Hi, I'm Sharon Kreider. I'm here in the Western CPE studio in Bozeman, Montana, and we're going to look at questions and answers that have come in from our webcast viewers on day one, the individual day of our webcast. Neil asked, has there been any further traction with regard to increased regulation on Section 1031 realty exchanges by requiring land for land or commercial for commercial, residential for residential, versus the current rule, which is realty for realty, real property for real property, personal property removed in TCJA. All right, so Neil, no, there has been nothing more on what's like-kind property after our change in TCJA. The regulations that were issued are on what is defined as real property versus personal property, since personal property can no longer be exchanged under 1031. You can still exchange land for an office building or an office building for an apartment building. It is about like kind, that is, real property used in business or investment exchanged for real property used for business or investment. Real estate professionals. If you're a self-employed builder, building trade contractor, an architect, or other realty subcontractor, does your profession inherently qualify you as a real estate professional to enable your rental losses to be written off against your operating income? So the answer to that is yes and no. Yes, you'll qualify as a real estate professional because, number one, you spend more than 750 hours in a real estate trade or business when you're a builder or a electrical subcontractor, plumbing subcontractor, an architect, or a real estate broker or real estate agent. So you qualify on test 1, more than 750 hours. You qualify on test 2 as a real estate professional because more than 50% of your work, of your work is from a real estate trade or business. Now, you may not qualify necessarily to deduct your rental losses against your operating income unless you meet test 3. And test 3 is that you materially participate in the rental activity. And you materially participate in the rental activity, generally, you spend more than 100 hours taking care of the property and no one spends more, or you spend more than 500 hours taking care of the property. Those are the two basic material participation tests. So your client has an apartment building, and they live in San Francisco, and their apartment building is in Houston, and it is fully managed. They probably will not qualify for those rental losses because they don't materially participate in the rental activity. They have it fully managed. They'd have to show more than 500 hours of time in order to claim those rental losses on the apartment building in Texas against their other operating income. Now, there might be a solution for that real estate professional, and that's under aggregation. And here's an aggregation question, but I want to talk about, so our contractor lives in San Francisco. He has 5 buildings. And if he makes an aggregation election, then maybe he can meet the 500-hour test because one of those buildings is in San Francisco, where he operates from. One of them's in San Jose. Those two he really takes care of. Then there are a couple in Houston and one in LA. But if he puts them all together and makes an aggregation election on the tax return, and that, remember, that is annual election, he makes an aggregation election that will help him meet perhaps the 500-hour material participation test. This question is a little different, though. It says, can an aggregation election be done on an amended return? And that answer is generally no. However, for 2018 only, the CARES Act allowed, no, that would be TCJA, allowed an amended return for the individual or the pass-through entity, the relevant pass-through entity, to treat a group of trades or businesses as aggregated without providing that disclosure statement. The IRS does have authority to disaggregate trades or businesses if I haven't properly made the election on a timely tax return. Do you think disaggregate is a word? Didn't spell check, but it is in the answers from the IRS. Why do we need a second cost segregation study? 2 question marks from our viewer. So you know that I get a cost segregation study on my shopping center when I buy it. I buy a new shopping center. I have a cost segregation study on it because I'm trying to break apart the building at 39-year depreciation, the parking lot at 15-year, maybe landscaping, parking lot, sprinkler systems at the 15-year, and then I want to find 7- and 5-year property included in my new shopping center. Why do I do that? I do the cost segregation study so I can get more depreciation up front. I'm not going to get any more depreciation over the 39 years than what I paid for the building, but I want the depreciation sooner. That's why I do a cost segregation study. Now, because of the change in TCJA, that personal property can no longer be exchanged tax deferred under Section 1031, I might need a second cost segregation study to establish the numbers I need on what I sold the personal property for. I'm looking at trying to figure out, this was my real property exchange and this was my personal property sale. And that's why I might want a cost segregation study. Now, I think what's really going to happen, I exchange this shopping center into a bigger shopping center. I probably should be using a different example during COVID when brick and mortars are having problems. But I am exchanging shopping center into bigger, better shopping center. And I'm going to get a cost segregation study on the new one so that I get rapid depreciation there on my recalculated basis because of the 1031 exchange rules. All right. I'm probably going to be looking there to see what faster items I might have in the personal property area so that I could have some bonus depreciation on the new property while I'm paying some gain on the sale of personal property on the old shopping center. So you can see it's a balancing act, and that's why when Karen Brosi was talking about real estate in our webcast, she was talking that maybe you'll need a cost segregation study as you leave your relinquished property and one as you enter your target property, your new property. So that's a few questions that have come in from our webcast viewers. We'll keep this up maybe every couple of weeks. I'll tell you a little bit more on the questions that are coming in. Some have no answers from the IRS. So sometimes we're just going to talk about what you and I believe is happening. In addition, we'll be talking on our webcast series on YouTube about the new law, just little pieces at a time. We will also, from Western CPE, be sending out e-tax alerts. If you are a subscriber to our e-tax alerts, you could expect those to be coming out to you regularly on the new law as we look at what Congress finally got around to. I'm Sharon Kreider at Western CPE.